All right, everyone, we're going to get started again today. Welcome to the Tower Wealth Advisory podcast series. I'm Tyler.
I'm Dave.
And today we're joined by a couple of gentlemen from Purpose Investments, one by the name of Kevin Black, who we'll spit over to in just a minute here. And we're going to hear a lot from Sandy Liang, who is the portfolio manager that we want to be interviewing and hearing from today. Before we jump into their presentation, I'd like to just do a couple of quick housekeeping items. Number one, as you guys know, if you've attended one of these before, we usually let our speaker present for about 40 or 45 minutes. We leave 10 to 15 minutes at the end of the presentation for open questions. Now you're on Zoom, so down on the bottom toolbar, there's an opportunity or a place where you can click in there and type your questions out. Dave and I see those questions on our end, and then we can relay them to our presenters and they can certainly answer them. Beyond that, second point that I have to make, this is a compliance related issue. They wanted us to touch on the fact that this is considered to be a high risk position for fixed income space. And we recommend that you consult with your personal financial advisors before you consider adding this to your portfolio. And we're going to speak to Sandy in more detail about that positioning and how his portfolio works. So before we get to them, I'd like to very briefly introduce Kevin Black, who is the Vice President of Sales in our region for, I believe, Alberta and Saskatchewan. Kevin is somebody that's worked closely with Dave and I for years. He's been a great support to our business. So we want to thank you for being here, Kevin. We want to thank Sandy for being here. And I'm just going to turn it over to you, Kevin, so that you can briefly introduce yourself and as well, Sandy.
And good afternoon, everyone. Thanks for joining us today. So as Tyler mentioned, my name's Kevin Black. I'm the VP of Western Canada for Purpose Investments. I do cover Alberta and Saskatchewan, and it's my pleasure to introduce today's guest, who will be speaking on the fixed income conundrum and how to find opportunity in today's bond market. Sandy Liang has 30 years of credit experience, with 13 of those on Wall Street, leading fixed income for Cobalt Capital, and as a senior managing director at Bear Stearns and Company in New York. His exceptional work in the field of fixed income and credit has earned him many accolades. Some of those include being named the All-American Fixed Income Research Team by Institutional Investor magazine for 7 consecutive years, fund manager winner for the best 5-year return among credit-focused funds, best 3-year and best 1 year in the Canadian Hedge Fund Awards, and he's a Morningstar 5-star manager and fund grade A+ manager. He received his BA from University of Western Ontario, his MBA from McGill University, and is a CFA charter holder. Now, before I open it up to Sandy, Dave, and Tyler, I just want to say one last thing. Sandy's got a great deal of experience. He's done well for those investors that he's looked after, me being one of them. He's a very deliberate and conscientious manager and has your interests in mind when protecting and growing your investments. So now that you know a little bit more about Sandy, I'd like to turn it back to Dave, Tyler, and Sandy to discuss the fund and the current fixed income environment.
Great. Thanks, Kevin. Sandy, we'll bring up your slides if you want, or do you want to speak a bit first?
Sure. Yeah, we can do slides. I will. I know Kevin went over my background, and thank you everyone for taking the time today. Maybe I'll just turn to page 4. So Kevin did go over my background, but I think that what is most important is that it's no secret that this has been a very tough year for bonds and stocks. And what's interesting is that bonds have been almost as volatile as the stocks, whereas bonds are supposed to be the bedrock in your portfolio. And the main reason is that interest rates have gone up. I mean, inflation's gone up, interest rates have gone up. That's not good for bonds. And I think that what's unique about my background and how it's relevant is that, we've just gone through a 40-year period where from, the early 1980s until really last year, bond yields only went down. So when bond yields only went down, that meant the price of bonds only went up. So you've been through a period where anyone who's been a bond manager within the last 40 years has generally had a successful time, because they've had the tailwinds of interest rates coming down. And I think that, myself and the team, we're very, very well suited for the environment from here going forward, because interest rates have been so low, there's no guarantee that they go up from here. And, if you look at my background, the team's background, yes, we are experts at bonds, but mostly we're experts at companies and industries. And we spend most of our time meeting with companies and management teams and studying industries and understanding the dynamics, because at the end of the day, if you buy a bond that's issued by a company, you're lending that company money. So, you really have to think more like a lender than a trader. And the trading mentality has been very good for the bond market for 40 years. But from here, I think that the dynamics have changed. So on the next page, this is our credit team. And there's 3 of these gentlemen that do credit full time. 2 of them also do stocks and bonds, so equities and debt. And I think that what you'll see about our credit team is that we specialize by industry, and we really think that is the key to creating alpha or generating return for our clients over and above the benchmarks, is really understanding the businesses that we're in. So I didn't really stop on the agenda. So what I'll do is I'll tell you what I'll talk about. I mean, first of all, I'll talk about our investing style a little bit, and I touched on that already. And then I'll talk about the Credit Opportunities Fund, really, and I'll give you a history of the fund, what it is, and where it came from. And finally, I'll talk about some of the most relevant issues today in fixed income in the investment world. So, I guess the next slide, page 8. The next one, investment process. So as fund managers, myself and the team, we run about $1.1 billion in credit investments. And, a lot of times you get the question, how do you do it? I mean, what's the process? Because I remember starting my first hedge fund job in New York. After I'd been a publishing analyst for decades, I started my first hedge fund job, and that was in 2009. And, when you're in a hedge fund office in New York and you have 4 screens in front of you and you have prices and charts and there's research on your desk, the question is, how do you turn this into generating returns? First of all, is you meet with a lot of companies you get out of the office. But, this slide is just something that we put together in terms of, it really summarizes, our process, how we get to where we get, which is a portfolio of 50 or 70 great investment ideas. And step number 1, conceptualization, we do a lot of screening. We have databases that have company characteristics. We do a lot of networking for ideas. We meet with people. We have contacts, both on the buy side, other, fellow investors, sell side, which would be brokers. We have a lot of different charts of time series that we watch. And, the idea generation process is really something that comes with experience, where the more you get out there, the more you see, the more screens that you run, you get better at recognizing what might be interesting, because the reality is that there's tons and tons and tons of potential investment ideas. But, a great investment idea is something that has asymmetric return, where, you could make a lot more money and, lose a little bit of money. It's kind of like poker, where sometimes you're looking at the pot and you look at your pot odds. If I bet a little bit more, can I win the whole pot, or is this kind of more like a 50-50 thing? So we're constantly in search of asymmetric reward per unit of risk. Step 2, conviction phase. That's when we get a little bit more in the weeds. We go see the management, or now we do Zooms with management. Often we meet management at conferences. We tour facilities. We build financial models, which kind of forecast how companies' performance is going to be. And at some point, we get some conviction in our idea. And once we have something in the portfolio, there's certain things that we have to do to make sure that we don't have stale ideas, where we have to stay on top of their earnings, forecast their earnings, compare how they're doing versus how we expected. And when securities prices move, we have certain risk management procedures as well. So on the next page, investment philosophy. What's super important for us, and this goes back to being investors as opposed to just bond managers. What's super important for us is to understand not just the company that we're invested in, but all parts of what we call the capital structure. And the capital structure is something where if you look at how a company, how they're set up, they will have borrowed money from a bank. They will have issued bonds. They might have a stock that trades publicly that you can buy and sell. There's different relationships between the different securities, and we want to make sure that when we're in a company, that we are in the best part of the capital structure and we understand how that capital structure works. So we try to be opportunistic, because if we're going to spend all that time on a company, we don't just have to look at their debt. The other thing that I'll mention that is super important is that when you buy bonds of a company, you're basically lending them money. And one thing about investing, and I think that this is not necessarily something that is really commonly a belief is commonly held, but when we're investing, we're not right all the time. I mean, investing is not an exact science, and the point with having a portfolio is that often a lot of things happen that you won't expect. You will be wrong. And, part of the art versus science of investing is making sure that, if you're in a bond, that even if you're wrong, there's a really good chance you get your money back. And so, we think about cash flow and asset value protection, where, the quote there is, you need a plan B, where often things don't work out. And we just, we have to be in a position where there's assets at the company that will help get us paid back. Maybe it's real estate value, maybe it's strategic value in the company. But the thing about investing is that everybody has a forecast, and your forecast is often going to be very, very wrong. And when that happens, you still have to be in a position to not have what we would call a permanent loss of capital. So from there, maybe I'll just talk about our fund a little bit, which is on page 11. So it's, let's see, there we go. So we have this fund. It's called the Purpose Credit Opportunities Fund. And just, back to my background, I worked in New York from 1999 till late 2011. I got back to Canada, got back to Toronto, and started this fund with a partner in fall 2013, and we opened it up to outside investors in June 2014. So it has, in terms of having outside investors, a track record of more than 8 years, which is kind of unique in what we call this liquid alt space. And it's a kind of fund where, we can actually bet for things and bet against them. We can go long and short. And in mid 2019, in Canada, there was a rule that was changed where you could actually short things in a fund where any investor can buy it. You don't have to sign paperwork. You don't have to be rich. You can just buy this. And now, so we changed this into a liquid alt. It's been the same investment strategy throughout. And then a little more than a year ago, we introduced an ETF, an exchange traded fund. But the point is that myself and the team, I've been running this fund for more than 8 years. The team has been on it for most of that time. And it's been the same strategy, the same way we generate return for investors the whole time. And so that makes it unique in the liquid alt space, because in the liquid alt space, there's a lot of fund companies that have introduced products to meet a need more recently. But so the objective is to achieve equity-like rates of return, but primarily from credit investments. So credit investments means we're buying bonds, we're buying bank loans, we're buying convertible debt. Generally, credit investments have a lot less risk than stocks. And the reason they have less risk is because if you look at how a company's capital structure is set up, basically people who lend money to companies have to get paid before the equity owners get paid. There's a ranking in the cap structure. So by definition, if you're closer to the assets, if you're senior to the stock, then you should have less risk. So the objective is to achieve rates of return as if we own the company, but by being primarily a lender. In terms of fund structure, it's a prospectus fund, which means that anyone can buy it. We provide daily liquidity and we price it daily, which is, when you actually learn a little bit about credit, you realize that there's a lot of people that are in the lending business that take your money, and if you want to get your money back from them, you have to give them months and months of notice. Whereas what we do is we buy bonds or things that actually trade every day. So if you're an investor in this fund and you ask for your money back, you'll actually have it back in a couple of days. Risk management, we have a risk committee. So that's a body other than the people that run the fund to understand where our exposure is. And in terms of managing risk, we also do things that kind of lower the correlation with the overall market. We bet against securities. And aside from our core lending activities, sometimes we do some more active currency management, take on more US dollar exposure and things like that. So there is a performance fee in the fund, and that means that if our unit holders are making money, then we get a share of the profits, but only if unit holders are making money. So on the next page, page 12, just fund accolades. Hello?
You're looking at fund accolades, is that correct?
Oh, yes. Thank you.
Yeah.
So this fund's been around for 8 years. We've got a number of awards in the fund. The credit focus category is it's a category in the Canadian Hedge Fund Awards, and they actually took place this week. I think of all the credit hedge funds in the country, most recently we ranked second in 5-year returns, and we have been first in the past. But one of my favorite investors, his name is Howard Marks, who is a chairman of a firm called Oaktree, which is a U.S. firm. What Howard Marks says is that when it comes to your investment manager, you don't want the guy that's always number one, because that means that he's taking a lot of risk, or he or she. So second place is not bad, because you can bet we're not getting over our skis in terms of risk just to generate return, as an aside. So why don't we do this? Why don't we skip ahead to because there's material in here on performance history, and that's pretty self-explanatory. There's a bit about what's in the fund, the kinds of securities, but I did want to talk about a couple things. Number one, why don't we go to page 17, top 15 security holdings? And basically, this is a list of the top bonds in the portfolio, and it's in alphabetical order, so it's not by weighting. And the coupon rate is as if the coupons, the rate, as if the bonds were priced at par or 100 cents on the dollar. And you can bet that with a very difficult year in the bond market this year, there's a lot of bonds that are trading well below par value because interest rates have gone up. So in the whole fund, the internal rate in the fund, so if you looked at the coupon rate in the whole fund in total, and taking into account the price of the bonds, we're generating roughly 8.5% in the portfolio. But the one takeaway from here is that if you look at our holdings, they're all companies, and with a couple of exceptions, there's some investment grade debt in the States. But you've generally heard of these companies: Royal Bank of Canada, Dish Networks, which is a big satellite TV provider in the States. We're in that for the asset value. You can generally Google the companies that we're in, and really, what I just wanted to make the point that what we're doing is very, very transparent. We generally lend money to companies, and there's a lot of fixed income or liquid alts out there where sometimes you look at their holdings. And, if you hadn't heard of anything, even if you Google everything, you can't come up with what it is that they own or how much risk that they're taking. Whereas, I think that what's really digestible about our strategy is that at the end of the day, we're lending money to companies, and you can see what these companies do. So, on this list, there's an auto parts issuer, there's Royal Bank of Canada, there's oil refiners. There's companies that are in the mortgage lending business in the States. I mean, you can generally figure out what our holdings do. So maybe I'll skip ahead to page 20 and talk about just this chart is not a chart of our returns. This chart is a chart of how the high yield debt market has done in the States. And the high yield debt market is basically the market of companies that borrow money in the bond market. And, there's different credit ratings where there's investment grade, which is rated BBB or higher, BBB, single A, triple A, things like that. Canada has a credit rating of AAA. And then the next tier is BB and lower. And that's really the core of what we do. It isn't always what we do, but it's generally, the market we have a lot of securities in. And if you look at the market as a whole, these are the annual returns going back roughly 30 years. And, you can see that these annual returns are actually, they're somewhat volatile, but they're not nearly as volatile as stocks. In here, there's only one instance where the high yield bond market was down almost 30%, and that was in credit crisis 08. But actually, if you look at 08 and 09 combined, and you average them out, it ended up being actually not a bad period to be in the market. So, the one thing that I wanted to stress about this chart is that we call this our white space, because we use the high yield market. It's a roughly $2 trillion market in the States. We use this market to find great investment ideas. And the market as a whole generates almost as much return as equities, as your stocks, but with a lot less risk. And so, we're starting from a place that has pretty good returns, less risk than the stock market. I think it's a pretty good place to find white space. So why don't we go to the road ahead? And I just want to review some things on the next page, page 23. Sorry, the dashboard. Next page. So, we call this a dashboard because for us, it's always very helpful to look at our starting point, especially because we're in credit. How much money are you getting lending money to the US government for 10 years? I guess this is as of month end. So yields have come down a little bit, but in round numbers, 10-year bond yields are around 4%. Investment grade corporate debt. So remember, that's the kind of the higher quality BBB rate, BBB and higher, 6%. And I think now it's about 5.5%. Bond yields in high yield here, they're about 9%. They're still around 9%. The dividend yield in the S&P 500 is around 2%. So that's kind of your starting point in terms of where you get yield. Now, what's not on here is the most recent inflation rate, which, if you're reading the news, you get that in the States, inflation is around 7%. I think it's around that in Canada as well. And the point I want to make about inflation is that inflation is in the news a lot. And it's not really, I'm not sure if this is common knowledge, because bond yields and interest rates have been low really since the credit crisis. But if you look back decades in terms of where bond yields should be, investors have generally gotten paid the rate of inflation in their bond yields. So to the extent that inflation right now is 7%, if you thought inflation was going to stay at 7%, then you would think that bond yields should be 7% or higher. They're not. They're 4%. I guess the point I want to make is that that's the conundrum today, where inflation is very high, and bond yields are kind of, they're not the 1.5% they were a year and a half ago, but interest rates are still really not that high. And if you look at the history of the bond market, and this is super important, if you go back to the period before the credit crisis, 08, 09, if you look back decades, bond yields have generally been above the rate of inflation. So if you're looking at this table and you're thinking that, well, I could lend the US government money for 30 years, I could make 4%. From a historical perspective, 4% seems okay based on the last 3 years, but if you think back decades, 4% is really not that great. So, I want to take that concept a little further on page 27. Okay, so we know that the bond market has had a tough 2022, and the red line just shows what bond yields have done since the beginning of 2021, so the last 2 years. And bond funds have generally lost 10 to 15% in total, but on top of that, you've lost almost 7 or 8% in buying power. So you're really like your purchasing power on your bonds is down just in almost 2 years, is down 20-25%. And to put this, we really want to put this in perspective because this is a long-term chart of the U.S. 10-year, so it's a benchmark 10-year yield in the States going back decades. And you can see that if we are in a period where that 40-year bull market in bonds is over, and we're kind of in a period where inflation could be a little bit higher, just by being in bonds alone and not having a strategy to make money other than interest rates coming down, you're probably taking a lot of risk because rates have come down for the last 40 years. But you can see in the period from the early 60s to the early 80s, bond yields actually went up for a few decades. So if we have if we have another period like that, you're actually taking a lot of risk if you're just in bonds on their own. So I think that's a pretty important point when you think about your bond portfolio and the kind of bond funds that you're going to own. I do want to talk about one other thing, and I'll go back a few slides, which is page 25 in terms of the numbered pages. Okay, the name of this slide is The Best House in a Bad Neighborhood. 40% money supply growth makes 2022 business cycle unique. And, this really, there's a lot going on in the world right now that's really tough to forecast what happens. It's tough to forecast what happens in China. We know that, they're going through a zero tolerance COVID lockdown policy. Europe is going through not just a war, but an energy transition where Europe has to find new sources of natural gas. That could take decades, or at least, maybe a decade. And, what's really important about this business cycle, just getting back to the US, is that, obviously we're going through a slowdown. There's a lot of reasons why one would think there's going to be a recession in the States. We could be in one right now. But certainly 2023, it looks like there's a pretty high chance of a recession. And, one thing that we wanted to point out is that we just went through a period after the pandemic where there was a lot of money printed. When I say money printed, money supply went up. Money supply is generally defined as cash in the bank plus money market funds, cash in corporate balance sheets. And so there's this time series called M2 money supply, which is one of the definitions of money supply. We actually have this chart going back 150 years. But if you look at that blue line at the top, M2 money supply growth year over year, basically you let the supply of money go up post-pandemic almost 40%. And that was really because there were massive budget deficits run in the US to combat the pandemic. And then the US went and poured a bunch of money in the bond market, and then they bought their own bonds. And so they basically create a lot of money to fight the pandemic. And that 40% is literally unprecedented in history. There's never been a time where there's been that much money printed in a short period of time. And that, that plus 40% explains a lot of things that we've seen happen just in terms of, everyday things if you're not in the financial markets, but what happened to house prices in Canada, Toronto, Vancouver. What happened with cryptocurrencies, what happened with growth stocks. I mean, everything went up. And it just seemed that, because there wasn't really a cost of money then, and there was money being printed, that certainly things became more expensive, and now we're paying for it because, it's common sense. If you print 40% more money, stuff is going to cost more. But the one point I really wanted to make here on this chart is that we're still in this hangover period where there's still a lot of liquidity out there. There's still a lot of indications that the money that was printed is still on corporate balance sheets, is still in people's bank accounts. I think that anecdotally, when I talk to advisors across the country, they think their clients have more cash than they had, for instance, in early 2020. There's just a lot of reasons why there's more cash out there than there has been, and that's probably a good cushion from the kind of recession that's coming, where this feels very different than 2008, where in 2008, there wasn't really any excess liquidity. In fact, everyone had too much debt and no cash. So now we have a situation where, the red line is money market fund assets. And generally, people have more equity in their homes. Even though home prices are coming down, people have more equity in their homes than they did in 08. Corporate balance sheets have a lot of cash. There's a lot of investor cash on the sidelines. So, the one takeaway is that I know that there's been a lot of negative sentiment out there. People are really worried about the economy. But, I think that inflation did peak earlier this year, and there's still a lot of excess liquidity. So, I think that we're a little bit more optimistic in terms of what happens in the business in the next 12 to 18 months. So, with that, maybe I'll see if Dave and Tyler have questions, or you want to open it up to anyone else.
Yeah, we got a few questions, Sandy. Thanks very much for sharing some of your insights there around the high yield credit market. One of the things that we are always trying to do is look into our crystal ball and know exactly what's going to happen in the next year. Out of curiosity, what's your expectations around the high yield market next year? I kind of get a feel for it from your presentation, but.
Yeah, the thing about expectations is that, having done this a while, generally the best time to buy my fund is when I personally are the most dejected. Because sentiment is psychology in investing is an interesting thing, where when everyone is really, unhappy and pessimistic, that's generally the best time to buy. But having said that, we try to work with objective indicators, and without a doubt, the most, the best forward indicator of total return is yield. And when I say yield, it's interest rate plus the credit spread, the additional yield that these companies give us because they're not the government, the credit spread. And the yield in the high yield debt market is roughly 9%. It's really hard to lose money at 9% yields. You'd have to have disastrous things happen, because when I say the yield is 9%, that means that is the interest that companies are paying every single day. And every single day you're in the market, the accrued interest goes up. So, the yield indication is pretty good. Away from that, I think that I am in the camp that inflation has peaked and inflation isn't getting worse from here. There's a lot of things that could screw that up, to be honest. Maybe China emerges from their zero COVID policy and starts to demand things like metals and oil again. Maybe European, things that are going on in Europe, like the Russian oil embargo, makes oil prices go up. Maybe their natural prices actually go up again because, they're not taking Russian gas anymore. That stuff is really, looking out 12 to 18 months, it's a lot tougher to figure out. And that's why, for us, we're very focused on our investments on a micro basis. And on a macro basis, in terms of the big picture, we don't think that it's glaringly obvious right now what you do with your traditional fixed income. And, I'll explain why. I did mention that inflation is 7%. And for decades, your inflation rate was actually lower than the rate of your bond yields, right? So, if you were to say, hey, if inflation's 7% for 10 years, I don't think it will be, because that's an exponential rate, but inflation was 7% for 10 years, where should your bond yields be? And the answer is 8 or 9%. Like, it's a big number. And if bond yields are 8 or 9%, that's actually horrible for everything. I'm not saying that's going to happen, But we are in a situation where inflation is high and bond yields are kind of, in the middle. And the question is, what happens, where's the truth in the next year? And I can tell you that, I don't think anyone is an expert at forecasting what happens to inflation after, we've had 40% M2 money supply growth, and that M2 money supply growth is going back to roughly flat. So, we don't have a forecast, we have a base case. And in that base case, returns are pretty good because yields are actually quite high. And, from there, we kind of work around in terms of the different businesses that we're in and look at, sensitivity to different factors.
So does a recession affect your base case? Are you expecting a recession, I guess, and building that into your base case, or how does it play out?
Yeah, I mean, a recession is it really depends on the business. Where, there's a lot of debate in the energy market, for example, where, energy is driven by supply and demand. And the demand side is very much driven by economic growth. And if there's a recession, then, there could be less oil demand over the period. But at the same time, energy supply has been quite constrained. And if you're in the States and you're looking at, say, product inventory, which would be gasoline, diesel, jet fuel, product inventory is actually quite low. Crude oil inventory is quite low. And, I could make the case that in the last 6 months, the U.S. has been selling oil out of their strategic petroleum reserve at the same time that China has pretty much been in a recession because of zero COVID lockdown. So maybe there's a recession, but, at the same time, maybe oil demand is higher because China comes back and oil supply is lower because, the U.S. is not selling their oil anymore. So, for every specific business, there's a lot of moving parts. And, as a general statement, high yield spreads generally expand in a recession. High yield defaults go up in a recession. But at the same time, interest rates are quite high right now. And so if you have kind of, the high yield market at 9% or 10% in that area, and interest rates actually come down, then the spread increases, but your return doesn't really change, right? Because your overall yield is going to be the same. So, I think recession is a very broad term where, we could be in a recession right now, because the reality is that the National Bureau of Economic Statistics doesn't even identify whether we were in a recession until 6 months after the fact. But, if you're in the investment business, you really have to be skating to where the puck is going, as opposed to where the puck has been. So, you know what? I know, Tyler, it's not a great answer, but I guess the real answer is that it's complicated. There's a lot of moving parts.
Well, I've heard that skate to where the puck is going comment a lot over the last couple of weeks and months. So you're not the only one that says that.
Yeah, I mean, that's so, and that it's funny that skate, like we say that a lot. And I just want to, skate to where the puck is going that is the essence of the investment business. And because everyone is focused on what's going on today. And if you're focused on everything that's going on today, you're probably focused on consensus, because usually everything you read about the paper, the concerns of people today is usually consensus concerns. Like, for example, everyone is very obsessed right now with how much are the Fed going to raise rates? Is the Fed funds rate going to be at 4.5% next year, 5% next year? And everyone is parsing every speech, every statement that comes out of the Fed for a clue to what happens a year from now. And, that's very kind of first order thinking, where if you have skate to where the puck is going thinking, you think, well, what drives what the Fed does? It's inflation, right? So what drives inflation? Money supply growth drives inflation. So when we started hedging or, shorting long bonds, and this is, in fall 2021, early 2021, it was because money supply growth was off the charts. inflation hadn't really done anything yet. But if you look at money supply going back, decades and decades, whenever there's a spike in money supply growth, inflation is sure to follow. And so knowing that relationship, we kind of skate to where the puck was going, where no one was really concerned, very concerned about inflation starting from, I guess, fall of 2020. And we felt like, even the Fed at the time, they're saying inflation is transitory. And if you were actually following what the Fed was thinking or doing or saying every other week, you'd be saying, inflation's transitory, it's probably coming down. So you really got to skate to where the puck is going and not get so obsessed with every Fed statement.
And Sandy, Tyler and Dave, if I could just jump in. Sandy, one of the things that we've spoken a lot over our years and relationship together, and one of the things that you've taught me is just kind of the difference why you like high yield bonds over things like equities and other uncertain asset classes. Like maybe you can touch on kind of the certainty of bonds and
Sure.
The homework that if you do your homework, you kind of know your outcomes. And so maybe you can share that a little bit for the audience. And that might answer one of the questions that's in the Q&A about, how do you take advantage of the fixed income space today?
Sure. So high yield is a unique area where, you're actually getting, in the history of the high yield market, you're getting equity-like rates of return, right? Like the yield in the market is 9% today. If you take the whole market and add it up together, you're making 9% yield, lending to a lot of companies that, are very, very creditworthy. But, the one factor that, and I think this is really underappreciated in Canada, because every time I pick up a Globe and Mail, they're calling them junk bonds, which is, that has been the name for the asset class. But in high yield, you have a contractual obligation and you rank ahead of the stock, right? So anyone who's taken their Canadian securities course is probably in one of the very first chapters, capital structure. If you're a lender to a company, you get paid before the stock owners get a dividend. And that's just fact, right? So, you're in a much better position versus equities. And the history is that you actually make almost as much return, but with a lot less risk. So that's a pretty good starting point in terms of, it's a very US centric market, and, there's not a lot of guys that do what I do in Canada. But if you're an expert at, being in this market, it's my professional world, then certainly that's a very good white space to find investments. And, once you accept that, so what is the white space? The white space is roughly $2 trillion of paper from many, many different industries. It's, and many different maturities. And there's, this paper that's secured by assets, there's unsecured. There's certainly a lot of things to choose from where, because it's a lending asset class, we don't believe in indexing because, when you're indexing an asset class where there's money lending going on, you're basically lending money to the companies that have borrowed the most money already. And that doesn't make sense to us. So we use the high yield market as a place to find great investment ideas. And inherently, the asset class has less risk than equities, and it has almost the same return historically. Also provides some liquidity where there's a lot of dealers. I mean, the dealers we do business with every day are JP Morgan, Goldman Sachs, Morgan Stanley. I mean, these are like household name investment banks that have bond desks that trade this stuff every single day. So, it's a very good asset class for finding investment ideas.
Yeah, and I think just
go ahead.
Oh, sorry, Dave. I was going to say, just from a simplicity point of view, one of the things you mentioned to me, Sandy, was, there's only two things you have to worry about is number one, will they pay their interest? And if they don't pay their interest, do you have assets that secure that bond for the value of it? And if you do the homework and you've got the assets there, then your investment is pretty secure.
Yeah, I mean, that's about, having done this a long time, it's really about, having a plan B, and also, not taking risks for just the sake of getting a better coupon, because there's so much to choose from, and the market is not necessarily so efficient where if you do your homework and you understand the companies, you understand what's on the balance sheets, then there's places where you can get paid a lot of coupon and take a lot less risk. I'll give you a real world example. Mattamy Homes it's a made in Canada, it's a private company. They don't have stock outstanding, but Mattamy Homes is the largest private home builder in Canada. You may have heard of them. They're owned by the Gilligan family, privately owned. And the reason they're privately owned is because they've never needed capital, because the company just makes so much money. If you look at the Mattamy Homes balance sheet, you'll see, three major components of assets. You'll see inventory and work in process. You'll see land and cash. And if you add those together, inventory, work in process, land, and cash, it equals roughly 2 times the debt. And for that, you're making about 8%. So in a home building company, you have hard assets and cash worth 2 times the debt, which is basically 50% loan to value, and you're making 8%. I mean, that seems pretty good on its own. But the home building business is very, very cyclical and could be in for lower earnings in the next few years. But one thing about Mattamy's balance sheet, that if you've done the work, you'll realize that their land holdings, much of which their land holdings was bought in the mid 2000s. And so if you're in Canada and you have a lot of land holdings that are inventory for building homes, and you bought the stuff 20 years ago, you could bet that it's appreciated well beyond what's on the balance sheet. And so, in terms of fair market value, we think that we're 3 times over collateralized in Mattamy. And you know what? The earnings will be volatile. I mean, there's going to be quarters where earnings are not great, and house prices are definitely on the way down. But given our asset value protection, given how good these guys are, what they do, they've been around for decades. We think that the chances of losing $1 of principal in this investment are quite low.
Just in the sense of the inflationary environment, high yield bonds. I mean, if you're someone who is deriving some of your income from your fixed income portfolio, I mean, what in your mind does a fixed income portfolio composition look like right now?
This is actually a pretty, obviously this is the question in your business right now, right? Because if the average bond in investment grade, so that's like the stuff that's really highly rated, gives you 5% yield, and then your fund expense is probably 1%, so you're getting net 4%. And then you're paying the government half in tax, so you're taking home 2%. Is it really worth the risk to be in traditional fixed income when if rates go up a little bit, you can actually lose a lot of money? I don't really have the answer to that question other than, I think it's super important for people's investment managers to actually have a way to create alpha or generate returns that don't just depend on rates coming down. Me personally, I own a lot of my fund because that's what I know and I understand the risk and the return has been, my family's primary compounding vehicle. It's, traditional fixed income is a conundrum because, inflation, I think, has peaked recently, but I don't think we're going back to 2% inflation anytime soon. I mean, I think that there's a lot of reasons why, 2% inflation would be really tough to do for years. And if 2% inflation is tough to do for years, then, does a 4% bond seem cheap? Like, I don't know, it seems okay.
What would you say, historically, in your opinion? I know there's some stats somewhere, we didn't dig them out, but volatility. So, I mean, on the risk reward front, if someone holds a traditional bond portfolio without high yield over a 10-year period compared to holding, say, your portfolio over 10 years, what's the difference in volatility?
That's a good question. I think that traditional bonds generally have less vol, but the problem with using a volatility measure is that, as a general statement, if you target asset classes and investing strategies that have less volatility, over time, you're going to make less money as well, right? So, and that statement is definitely true, where if your clients have a time horizon of a year, you don't really want that volatility. But if your clients have a time horizon 5 years plus, or if they're 50 years old and they're not going to retire for 20 years or 15 years, volatility is actually your friend, because over time, equities have a little more volatility than high yield bonds. They have a little more volatility than regular bonds. But the thing about regular bonds is that it's, what your return is going to be, and your return it's not going to be great unless inflation goes right back to where it was. And I think that, I really do think, for a number of reasons, those days are over.
I can also speak to, sorry, Dave, I just to finish up the question that you're asking, because I think it's a very important one. Some of the research that I've done with portfolio construction using Sandy's fund and adding it to a traditional fixed income, if you were to use 2/3 of the traditional fixed income with 1/3 of Sandy, historically, the actual volatility of that portfolio does not change. So it actually stays quite low, but your overall return increased fairly substantially over what the traditional fixed income did. So very good pairing to put them together and not increase the volatility.
Yeah, and I think that's how we look at our portfolio construction. It's not a question for Sandy, but just a comment overall. Obviously, when we're dealing with clients face to face, it's volatility comes up, and only in the context that they're completely comfortable with the volatility as markets are doing well. And the second things rear their ugly head, they always question that this is not what they signed up for. And so, as much as we understand the long term, and even if they're 10 years away from retirement or 5, they're 30 years in retirement. This money has to last for a long period of time. So we try to get them to reflect on that. And obviously, when the markets are down too, most clients are not willing to sell to rebalance to a lower risk portfolio or lower volatile. They always want it to, they'll do that when it bounces back up. But of course, when it bounces back up, they get really comfortable again with their volatility, and they don't want to make any changes. So we go through this cycle with our clients. I think the fixed income environment's kind of unique right now, obviously, with this spike in inflation, and whether it's going to stick with us, whether we're going to fall back to where we were. That's going to impact things for time to come. So I'll segue into the next question here that someone's popped up. In the high yield spot, it's about foreign exposure. Would you recommend foreign exposure? And I guess in the high yield space, the 95% of our exposure is in the United States. Is there much of a market in your high yield, like Canada, Europe, Japan, those type of things, or is that really not much space there?
Yeah, the U.S. high yield market it's actually a central place where you can get exposure in a lot of different countries. There's a lot of Canadian companies that, because there's not much of a market up here, they'll go and issue in U.S. dollars as opposed to issue in Canadian dollars, because the U.S. high yield market is much deeper and much more efficient. So, foreign exposure, that's probably not a question for me, where, we like to stick to our knitting in terms of companies and industries that we understand. It's really kind of a Warren Buffett principle. I'll give you an example. Last fall, about a year ago, there was a developer in China that blew up called Evergrande. And Evergrande was basically a home builder, apartment builder, had tons and tons of debt, and had issued a lot of debt to foreign investors as well. And at the time, the bonds collapsed to 30 cents on the dollar. And there was a ton trading. And there were a lot of research reports that said, hey, you know what, at 30 cents on the dollar, we think it's worth 50 cents on the dollar, listing all the reasons why. And, there was some logic there, but we just couldn't get comfortable with the China risk. And, maybe if I had spent my whole career in Hong Kong or, Shanghai or something, we would have been more comfortable with it. But, we elected to say no. And you know what? Those bonds could have done wonderfully well. But, they haven't, as you can imagine, because we know what's happened in China since then. But I guess my point is that we're very much in our investing style. We're very much, stick to your knitting, stick to what you understand, stick to the legal system that you know. And, we don't need 200 ideas. I mean, 50 ideas is good for us.
I think we got time. One more question you got there, and then we should wrap this up.
Okay. Just one quick question. Sandy mentioned a few times here that governments are certainly here in North America trying to target a 2%, inflation rate. And if it's not achievable, as you mentioned, you don't think it's achievable, at least not in the near term. How hard are they going to maybe push on interest rates? Like, are they just going to keep pushing and raising and trying to get to that 2%? Or is there a point where they kind of take the same perspective that you're suggesting here and say, 2% is not achievable? We're going to break something if we keep raising rates. What's your kind of feedback on that?
I mean, that's not a simple question at all, because
it was supposed to be a quick one, Sandy, there, so we could wrap up.
Yeah, I know. But the thing is, like,
this is a yes, no, isn't it?
There's a lot of the Fed's been raising rates to slow down the economy, because the conventional wisdom is, look, the economy is, GDP growth is slower, unemployment is higher, then there's less wage inflation, therefore there's less inflation. But I think that ignores a lot of underlying reasons why there's been inflation in the last couple of years. And a lot of it has nothing to do with the economy. We all know it has to do with, supply chain bottlenecks, obviously a lot of printed money. This whole Russia-Ukraine thing has, it's actually raised the prospect for higher inflation for some time, because, make a long story short, Europe was getting half its natural gas from Russia. You need natural gas to power, not just heat your homes, but power industry. And we're involved in a lot of businesses where North American natural gas is much cheaper, and we think our companies have a competitive advantage versus, European natural gas is literally, 5-6 times the price. But that has nothing to do with the Fed's, what the Fed's doing, right? I mean, the fact that natural gas is super expensive in Europe, and that's raising the price of diesel, of gasoline, of fertilizer, of specialty chemicals that go into a variety of products. That has nothing to do with the Fed. And that's why, if you look at our deck, we thought a month ago when sentiment was super negative, that there was actually a scenario where inflation could actually come down a little bit on its own and make the Fed just a little bit more accommodative, because, what they do with rates doesn't always have a direct relationship with inflation. If inflation actually eases a little bit, then that, kind of gives them a little window to not be so harsh. I like, there's the near term and then there's long term. Near term, I think near-term inflation has peaked, but 2% inflation is it's going to be tough, because in the days of 1% to 2% inflation, we had a lot of offshoring going on, where we had a lot of like Chinese cheap labor, cheap labor from all around the world because of very tight supply chains, and a lot of offshoring and globalization. That's kind of going the other way, right? Like, now we have deglobalization. We have everything coming back home. We have, like, companies want to control their own supply chain now. And so because of that, it just, it's going to make 2% inflation tougher.
Makes sense. So it wasn't a yes or no answer, but it is what we'll wrap up on. So Sandy, thank you very much for your time today. We really appreciate you sharing your insights with us around your fund and around the high yield credit market. Kevin, thanks for helping organize this. To our viewers, if anybody wants to learn more about this product or follow us, You can find us at towerwealth.com or follow us on social media. Thanks everybody for watching, and take care.